Hi, everyone. This is Jillian Sidoti with crowdfundinglawyers.net, and I'm with Nancee Tegeder, who's an associate with our firm. And before we get started on our webinar today about qualified opportunity funds, I wanted to tell you about our upcoming event, which you can sign up for at crowdfundinglawyers.net. It's the Ultimate Crowdfunding Workshop. We're going to be going over how to crowdfund your deals, how to raise money for any business, including real estate, what the rules are, how to do a Regulation A. We're going to talk about qualified opportunity zone funds and how to start those when you come on down. And it's in Orlando on February 7th and 8th. And so you got to sign up soon because it's only a month away. So I really want to encourage you. Plane tickets are cheap right now, and it's at a really nice resort. It's the Sheraton Lake Buena Vista Resort right in Orlando. So we hope to see you there. I will stop talking about that. And without further ado, I'm going to turn it over to Nancee. I'm actually going to pass the mouse to her, and she's going to click through and tell you all about qualified opportunity zones.
All right. Hey, everybody. Welcome. Our topic today, qualified opportunity funds. You just met us, Nancee and Jillian. Great. All right. So in 2017, Congress passed the Tax Cuts and Jobs Act. And in that act, there was some information about qualified opportunity zones. And it's very new, and there's been a lot happening through 2018 where we're getting to learn more about it. So I'm going to update you on what we know so far and what's coming. In October, they released some preliminary regulations. And so that gave us a little bit more clarification on opportunity zones, and we're expecting some more regulations to come out this month. We'll see, and we're hoping, I know they give us a deadline, and it's usually a little bit later after that. And then we're hoping by spring everything will be finalized. So right now they're accepting public comment on everything and working out all the questions. So you'll see as we go through this that there's still a lot of unanswered stuff. So we'll let you know what we know and what we don't know and what we're still waiting to figure out.
You know, I do want to say something to that effect. When the Jobs Act passed, which is the Jobs Act, that was the Jumpstart Our Business Startups Act, which is the crowdfunding act back in 2012, it took them 4 years to come up with the rules. So I feel like this is a really short timeline, but we'll see.
And they're doing great, right? I mean, they've got a lot of really great regulations out. So I think they have a special commission in Washington that's working specifically on this. So they're really working hard to make it happen. So we'll start with just figuring out what a qualified opportunity zone is. And what happened there throughout the United States and Puerto Rico, there's over 8,000 zones, and these are distressed areas, and the government wants to stimulate growth and economic development. And so they're providing tax benefits, and I'll get into those specific benefits, to help investors want to put money into these areas. There's so many, so obviously we can't say them right here, but we have a link here where you can go and look up the zones. They're listed by census tracts, but you can just Google any, opportunity zone map, and you'll be able to find it. Just be sure when you look at the map, it's not necessarily the highlighted part. Some parts that are highlighted are not opportunity zones, and some are. So what you do is you hover the cursor over the zone, and there's actually a designation where it says opportunity zone, yes or no. And so you can.
Oh, that's neat.
And I say that because in a lot of the clients we've worked with, they'll look at a property, and there might be one property that is in the opportunity zone, and right across the street or right next door, it's not in the opportunity zone.
Oh, that's interesting.
Right. So you want to be very careful to make sure you actually do have the property in the opportunity zone that you're looking at. So anyway, we'll start with the exciting part, are the tax benefits for investors. And as far as for our clients, this is a great incentive for finding people who want to invest money. And this is a great marketing tool to provide some incentives. So there's two parts. There's a deferral and a reduction. So the first part with the deferral, if an investor has capital gains, and actually I'm going to back up with that. So capital gains with opportunity zones can be from anywhere. Typically you look at doing real estate capital gains to real estate capital gains. Well, that's a nice bonus with opportunity zones, is it can be capital gains from stocks, from pharmacy, from artwork, from anything. You can take capital gains from anywhere and put it into opportunity funds.
Oh, so unlike a 1031 where it has to be one proper, like kind exchange.
Exactly.
Oh, that's cool.
So that's a great benefit. So if you have somebody you know who has a lot of money in stocks and they've been wanting to get into real estate, but have not wanted to be penalized with the capital gains tax, this is a great chance for them to jump into the real estate arena.
I think this makes sense at this point in time too. Like we're seeing the stock market have some volatility in it, and it looks like it's on the horizon of coming to a down economy. So to me, it would make perfect sense to take money out of the stock market right now and look specifically for an opportunity zone.
Exactly.
Yeah.
Yeah. And if you decide to do that, then you get all these additional benefits. So the first one is you defer paying taxes on any of your capital gains until the end of 2026. You still will have to pay the taxes, but at least you have a deferral for quite a bit of time, which is great. And you mentioned the 1031.
Yeah.
So with the 1031, if you're rolling over your gains from that into another property, you have to roll over the base that you paid as well as any appreciation. That's another bonus with the opportunity zones is you can segregate those amounts.
Oh, neat.
So if I bought a property for $100,000 and it appreciated to $150,000, if I sold it, I could keep that $100,000 base and do whatever I want with it, and take the $50,000 capital gains and throw it into.
That's really cool.
So that's another great benefit. So the trick is whenever you do get your capital gains, you have 180 days before you have to invest it. So you want to make sure you fall within that time frame so that you qualify under the opportunity zone. And then I'll get to the bullet point about selling the property in 2047. Actually, that relates in a little bit. They do have a restriction. Obviously, you can't have your gain come from a sale to a related party. If you own an LLC and you sell it to yourself, they don't want you, messing all that up. So it has to be a legitimate sell and increase of capital gain. So that's the first advantage is the deferral. The second one's even more exciting, and that's a reduction in taxes that you pay on your capital gains. And so they have a time frame set up where if you put your funds, your capital gains, into an opportunity zone and you leave it there for 5 years, then you actually will only be paying capital gains tax on 90% of that amount.
Oh.
So you reduce your basis by 10%, or you reduce the amount you pay off by 10%. So I'll give an example. Let's say you have a capital gains tax of capital gains of $10,000, and you throw that into an opportunity fund, and you leave it in there for 5 years, and then you pull it out. You're not going to pay taxes on the $10,000. You'll just pay it on the $9,000. It will reduce.
Oh, neat. Okay, great.
And that's just
wow. That's really cool.
That's great. And again, if you leave it in there even longer, the 7 years, then it goes another 5% down. So then you only pay it on the $8,500.
So it's funny because it looks like, based on your last slide, you want to keep it in there for at least 10 years, but no more than 30 years or no more than 28 years or something like that?
So I'll go back to that slide. So let's go. So let me say one more advantage, and then that will make more sense. So that 15% comes in at 7 years, and then the greatest advantage comes at the 10-year mark.
Yeah.
So not only do you get that 15% reduction in what you're paying your capital gains tax on, but also whatever asset you invest in, if it appreciates, you don't pay any tax on that appreciation.
After 10 years.
After 10 years.
Holy moly.
So let's go back here. So that benefit of not paying a tax on appreciation after 10 years lasts until 2047.
Okay.
That's why I have the 47 there. So these two work together, and the reason I say that is the deferral is only available until 2026.
Okay.
So if you want to take advantage of that 7-year investment and get the entire 15% reduction, you have to invest by the end of 2019.
Oh, okay. Oh, okay. So you got to do this now. This is like one of those act now.
Right.
So act now if you want to start an opportunity zone fund. You know where to call.
If you wait, another 2 years, you only get the 5%, and after that, you wouldn't get any of that.
Okay, so that you don't want to do that.
So if you want to take advantage of both of these opportunities, got to get it done by the end of this year. So we've seen a great increase in interest for opportunity zones, and that's probably why you're hearing the buzzwords all over the place. Again, let's say you miss this 2019 window and you invest, in 2027 or whatever. You wouldn't get the deferral of gains, and you wouldn't get the 5 and 10% or the 10 and 15% reduction. But you still could take advantage of not paying taxes on appreciation as long as it's in there for that 10 years. So that's with the investors. So investors might have concerns about investing, and some of those I've got listed here. But obviously, whenever an investor puts money into a offering, the management is handling everything. But we find that usually investors don't want to be involved. They want someone else to handle all that for them, and they're willing to pay fees for that. But those may be some things they're looking at. Even though I have these tax benefits, I won't have as much control. But usually that's not an issue for them because they don't want to. And we just need to make sure that the investors do take that deferral on their tax forms. And obviously, if you're investing in opportunity zones, these are risky areas, very distressed, so that they're a little bit higher risk sometimes. But the idea is that a lot of people are going to be investing in these areas and really developing them. So.
Now, I want to pause there real quick because there's something I forgot to mention at the beginning of the presentation, unfortunately, which is that we are on a time crunch today. So we cannot take questions at the end of this presentation live. So what we're asking you to do is to please use the question bar to ask your questions, and we will have them answered on our Facebook page. If you go to Crowdfunding Lawyers Facebook page, all of your questions will be answered there after the conclusion of the webinar, but please don't hesitate to ask questions in the question bar. That's how we're going to get your questions. And the other thing is, too, we'll also have our contact information at the end of this presentation, and you can reach out to us if you have a more personal question.
All right, as far as for syndicators, and that's who we work with, this, like I said, is a great marketing tool. You've got lots of people out there with capital gains. They don't want to pay tax on it. This is a great place for them to file their money. And just from a humanitarian standpoint, you're helping these communities that are in need of investment, and you're doing good things for that. So that's great. We have a lot of questions on, is this more expensive than a regular offering? And no, it's the same cost. It depends on how much you're raising, but the opportunity zone factor does not affect, it doesn't increase the cost. So we have occasionally found where our clients run the numbers that keeping investors' funds in for at least the 10 years, sometimes there will be diminishing returns, and it may not necessarily be the benefit, the tax benefits may not outweigh those diminishing returns. So you'll have to run the numbers and make sure that it makes sense. So this is definitely more of a long-term investment that you're looking at. And another thing to note is if someone just comes in with their own cash and it's not capital gains, they are not able to take advantage of these tax benefits. So it's really, and they're allowed to participate, that's fine, but it's really directed at those who are trying to save some taxes with the capital gains. And then the 1031, there's still a lot of open-ended questions with that the regulations are trying to work out. A few things we do know that are different. If you're doing a 1031 exchange, you have to put your money with the intermediary. If you are doing an opportunity zone investment, you don't have to do an intermediary. You can just invest your cash immediately, and that's fine. So that's one great difference. But if you pull out your capital gains from real estate and invest in an opportunity zone and enter it in as getting shares in an LLC, for example, you would lose that 1031 status, and it becomes personal property. So if you want to maintain that 1031 status and continue deferring your taxes beyond 2026, then you would just leave it in the 1031, and we'd create a TIC agreement for you and do that separately. And then as far as if you are the one running the fund, there's a form that you have to file with the IRS, and you basically self-certify. It's pretty easy. But if you aren't complying with all the rules, you can be penalized. And again, that's another thing. We don't know how you'll be penalized. There might be a fine. The nice thing they have clarified is that if the fund itself compliant with the rules, the investor won't lose that tax benefit.
Okay.
They can maintain it, but the actual person running the fund is the one that will be penalized.
It seems to me like if you wanted to find a good qualified opportunity zone, you want to find an opportunity zone that's next to like a nicer neighborhood.
That'd be great.
That's like where it will work out. Like, so if you could find the ghetto of San Jose, you'd be good to go.
You've got to go on the map. In California, I mean, we're in California, and they have over 800. I think all of Puerto Rico, the entire country.
No kidding. How cool is that?
So,
and then you have other tax advantages in Puerto Rico as well. That's really neat. Okay.
Set up some beachfront property. Anyway, so I mentioned, so if you want to come to us, we can help you with setting up the Qualified Opportunity Fund. That's what we do, and we just, like I mentioned, we file a self-certification form with the IRS. The rules I would say you need to comply with. The main rule is that 90% of the assets in your fund need to be in Qualified Opportunity Zones. So a lot of times we'll get the question of, hey, I already have this fund going and I want to pull in another property that's in an opportunity zone, and they know.
Don't do it.
No,
you don't even try it. Like, don't even try to mix properties at all, because at the end of the day, cash is an asset. So if you have 10% of your assets in cash, then you're going to have an issue there as well. So don't even try to mix qualified opportunity zone properties with non-qualified opportunity zone properties. You will fail on this rule for sure. So you have to have 100% property in qualified opportunity zone rules.
That's what we just recommend to
yeah.
all qualified opportunity zone. And in fact, you're supposed to set up an entirely separate entity. The purpose of that entity is to operate a qualified opportunity fund. So we help you set that up, and then you just keep everything within that fund in the qualified opportunity zone. Now, as part of that 90%, you can have some working capital, but there are some strict requirements that go along with that. You have to have a schedule that you're following, and there's a time frame that you have to be using it within. So they keep it pretty strict to make sure that development is actually happening and you're not just sitting on properties. Again, more than 50% of the total gross income should be coming from active business. You just can't have the money sitting in the bank account. They want you moving and making things happen. So when you look at these opportunity zones and looking for where you want to invest, you can find some vacant land or abandoned property. That's fine. They say sometimes you can find a building where the original intent or use of that building is for qualified opportunity funds. We're still waiting for clarification on what exactly that means. And then the more common one we see is there's an existing property, let's say an apartment building or a lot that you want to develop into a storage unit or something like that. That's where they have a few more requirements. If there's already an existing building, you have to substantially improve that property, and you have 30 months to do that in.
Yeah, so you basically, I mean, to me, what this says, and I've had this question before, which is that basically that property cannot be making any money for all intents and purposes. So you have to, I mean, those are risky properties. Vacant land is risky property. And anything that needs substantial improvement where you're doubling the value is pretty risky.
I do want to clarify, and this is something that came out in the preliminary regulations, is that it's not the entire value of the land, but just the value of the structure. So if you purchase a property for $100,000 and the lands were 70 and the buildings were 30, then you have to plan on putting 30,000 more into that building with renovations, improvement, or whatever, and you have 30 months to do that. So when you're setting up your finances or your projects, if you're purchasing an existing building, you need to make sure that you have the funding to double the value of that structure.
Now, one question I always get when these qualified opportunity zone funds come up is that, what about securities laws? I want to be very clear. These are IRS rules. These are tax rules we're all talking about here. You still have to comply with securities laws when putting together a fund and going out and getting investors for your deal. So you really need to figure, you got to follow these rules from the IRS perspective, And then on top of it, you have to go and do the normal paperwork as if you were doing any other fund and qualify under an exemption, usually, Rule 506, either B or C, under Regulation D, which is an exemption from registration. And you still have to do a private placement memorandum, you still have to do an operating agreement, subscription agreement, and file all your Form Ds. So I want to be very clear about that.
Yeah, I do get that question a lot. I think people get overwhelmed with, this is new rules, and we make it very simple to mesh the two together. But yeah, you do have to continue both of those. So we're still waiting on more answers, and as soon as regulations are released, we'll definitely review over those and get some updates out there. As far as we mentioned, we don't know the penalty if we aren't complying with the 90% rule. As far as how do you report the 90% rule, the assumption right now is you can show financial reports, and you need to show that at 6 months and 12 months of the tax year, and that is supposedly sufficient to establish that 90%. And within the fund, you are able to sell properties and purchase new properties and maintain that status, but we're still waiting on information on how long you have before you have to reinvest those funds. So lots of questions still out there, and we'll keep you informed, and let us know if you have any questions in the bar, and we'll get back to you as soon as we can.
Yes, and so don't forget to put your questions in the chat box above. We'll let this run for a few more minutes, but we're not going to take any questions live today. We will answer your questions on the Facebook page, at Crowdfunding Lawyers Facebook page. So check out that after this event, and we'll have your questions. We're hopefully going to start answering them right as soon as we're done here. And the other thing you should know is right up on our screen is our contact information. And if you want to learn more about securities laws or how to raise money, how to start a crowdfunding campaign, what are the different laws and rules and regulations regarding crowdfunding or setting up a fund or syndicating your first real estate deal, or perhaps you want to know how to market to investors and where to find investors, then you probably would want to come to our event in Orlando. It's in February. You can go to crowdfundinglawyers.net to sign up. Just go to our events page, and we hope to see you there. So thank you so much for coming out today, and we look forward to answering your questions.
Thanks, everyone.